everybody. Welcome to Larson Nonprofit University, where we will cover a topic for today. Today, we're going to go through nonprofit financial statement presentation. So the nonprofit organizations do have a pretty unique presentation in their financial statements when compared to for-profit companies or just other types of financial statements. So today we're going to go through the nonprofit financial statement presentation, and what we're going to cover are the statement of financial position, the statement of activities, the statement of functional expenses, and the statement of cash flows. So starting out, statement of financial position. So the statement of financial position is equivalent to a for-profit entity's balance sheet. Historically, nonprofits did not always present a classified statement of financial position. And a classified statement, what that is that breaks out current assets from current liabilities. In the past, it was pretty common for nonprofits to just show total assets and total liabilities, not broken out between current or long-term. However, in the maybe around 2015 or so, there was a new nonprofit reporting standard that came out that required more disclosures on the breakout between current and long-term. And so a lot of nonprofits switched their financial statements to present classified statements of financial position. And so it is a little bit more common now for them to be classified. Additionally, within the statement of financial position, the net assets are presented in there, and the net assets are essentially the nonprofit entity's equity. There's not ownership in a nonprofit typically, but just the equity, the retained earnings roll into these net asset classes. So net asset classes, they can either be classified as with donor restriction or without donor restriction. So contributions, as they come into the nonprofit, they will go into one of these two classes. And it's important to distinguish that these two classes are strictly based on donor intent. So they're not, the board doesn't have control. Management doesn't have control over where these contributions are classified. It's strictly based on the donor and what the donor is recommending or requesting from the organization that they're donating to. And then another thing to consider there too is that anytime a nonprofit has earned revenue, that the earned revenue will always be considered without donor restriction. And the reasoning for that is that earned revenue, they're getting something in return for that revenue or the money that they're providing to the nonprofit. And so because they're getting something in return, that is essentially the release of that restriction, if that's kind of an okay way to explain it. But those are just some things to consider with net asset classes. Some other things are the net asset classes on the statement of financial position. They can be broken out a little bit more. They can either be broken out in the footnotes to the financial statements, or they can be broken out on the face of the statement of financial position. And here's a quick example of that. If you do want to break it out on the statement of financial position, you could break it out between board designated or undesignated. And those are going to be within the without donor restriction classification. And then the with donor restriction classification, you can also break that out by the restriction type. So if it has a purpose restriction, you have to spend the funds on a specific purpose, then you would include that in the restricted by purpose. And if it is due to time, so promises to give or future periods, those are inherently time restricted. And so they're considered to be with donor restrictions in the sense that you can't spend them until they provide the funds to you. And so it has that time restriction to it. And so if you do not break these out on the statement of financial position, you do need to disclose these in the footnotes. It's just kind of your choice as to whether you do that here or whether you do that in the footnotes. So those are just some statement of financial position information. So let's get into the statement of activities. So the statement of activities, it's the equivalent of a for-profit entity's income statement. And the activity in the statement of activities does need to be presented by donor restrictions. And there are two types of methods that you can use to present the donor restrictions. Common terminology is the column format, or the pancake format, I think also known as the hamburger format. And I've got some example of those for you so we can kind of see what I'm talking about there. So the image to the left, this one shows an example of the pancake format or the hamburger format. And that's essentially it's stacked. So the top section is the change in net assets without donor restrictions, and that's usually how it's going to be presented. That section is going to be first. And then once it's presented the change in net assets without donor restrictions, below that, it presents the change in net assets with donor restrictions. And this can typically be presented on a comparative basis on one page. But the difficulty with that is that it sometimes, I guess the negatives of this one is that it is difficult sometimes for readers to see the total contributions because it is, it does have the without up above and the with below, to where you do have to, if you want to know what the total contributions are, you kind of have to look at both of them, do the math yourself, and determine, okay, what are total contributions combined between the without and the with donor restrictions. So the image to the left here, this is an example of the column format. And so this format, it typically results in the statement of activities being presented on 2 pages when you have comparative financial statements. And so you will have to look at both pages side by side to kind of get an idea of the changes year to year. But the positives here are that you do have the total of the 2 lines of with and without in the same section. So then you can see, okay, our total contributions are X amount, the combination of the without and the with donor restrictions. And so that's the benefit of this one. Like I said, the negative is you don't have the comparative year over year numbers right next to each other. You do have to look at the 2 pages there to kind of get that comparison going. Another example that you can do with the column format is that you can do a summarized comparative statement of activities. And the option here, though, is that it is not in accordance with GAAP because it's not fully comparative. And so you don't have the breakouts between without donor restrictions and with donor restrictions within the financial statements. And so it is not a GAAP presentation. And so you do have to include in the audit opinion a paragraph that just states that you have summarized comparative information. And then you also need to include a footnote in the financial statement footnotes that explains that as well. So you'll have that paragraph in the audit opinion and the paragraph in the footnotes. But the benefits to this one, as you can see in the statement of activities, is that you have that comparison of the totals on the same page. So you can see year to year what the totals, how those changed year over year. And so this isn't as common from what I've seen, but it is an option out there that some nonprofits do choose to follow. All right, another thing with the statement of activities are the presentation of the expenses. So the expenses of a nonprofit are broken out by activity type on the statement of activities. Some examples of the activities are program activities, general and administrative activities, and then also fundraising activities. And so an example of this here, so the image here on the left is an example of that expense presentation. So you can see here, in this case, it has program services, but then it also breaks out the 2 different programs that they have. And so you have the totals by program. You can just do 1 line for all program activities, but if you do that, you do have to have a footnote disclosure that that breaks out those programs, what the total expenses were there. And then you can also see the supporting services here are broken out, the general and administrative, and then the fundraising expenses. So the totals here are presented on the statement of activities. One thing to keep in mind is in the expense section, there will never be expenses in the with donor restrictions column. And that is because net assets with donor restrictions are always released before being expensed. And so up in the revenue section, there's a release of donor restrictions line that nets to zero, but it essentially moves it from the with donor restrictions line to the without donor restrictions, the with donor restrictions column, and then moves it to the without donor restrictions column, and then it's expensed below there. So that's just something to keep in mind with nonprofit statement of activities. Okay, let's get into the statement of functional expenses. So all nonprofits are required to report information about their expenses in one location. And that can either be on the face of the statement of activities, it can be in a schedule in the notes to the financial statements, or it can be in a separate financial statement. However, regardless of the location, the relationship between the functional classification and the natural classification should be presented in an analysis that disaggregates the functional expense classifications. And so I kind of got an example of that, but it will break those out. So here's an example of the statement of functional expenses. So in this case, this nonprofit has two programs, the core programs and community programs. And then there's the general and administrative and the fundraising. And so the totals here at the bottom of each column, those should agree to the statement of activities. And so in this case, the core programs are $950,000, the community programs are $600,000. So the combination of those will be the amount presented on the statement of activities for programs. However, that nonprofits are required to present these expenses by their natural classification. So this breaks them out, wages and salaries, payroll taxes, supplies, office expenses, depreciation, etc. And this is also a reporting in the Form 990 for nonprofits. And so there are going to be some comparisons and similarities between the Form 990 reporting and the reporting in the financial statements. Let's talk a little bit about the allocation of the statement of functional expenses. So the cost of the programs and the supporting services should be allocated on a functional basis. All direct costs should be charged to the functional area they pertain to. And then indirect costs should be charged to programs and supporting services based on management estimates. And they should also consider the expense and how it relates to that functional area. And then they are typically allocated based on an estimate of percentage of time and effort, or depending on the expense, it could also be allocated based on square footage of the office space used, like what percent of the square footage is used towards that program versus general and administrative. And then the allocation methods should be consistently applied year over year. So if I go back to the statement of activities, so you can see here, for example, there's the wages and salaries at the top. So the top line there. So there's about 1.1 million in total wages and salaries, but those total wages and salaries are allocated according to the methods that this nonprofit decided to allocate them across, but they're allocated across the programs, general and administrative, and fundraising. And so that's just an example of the allocation. Okay, let's talk a little bit about the statement of cash flows and footnotes. So the statement of cash flows for nonprofit organizations has the same basic requirements as for-profit entities. So the cash flows are split into three categories: the operating, investing, and financing. Entities do have the option to present the statement of cash flows using the direct method or the indirect method, similar to for-profits. And the indirect method is typically the most common method we'll see. But if the indirect method is used, disclosure of cash paid for interest and taxes is required. So you do have to keep that in mind. But once again, that is typically the most common method used in a cash flow statement. So here's an example of the statement of cash flows. So you can see here, this is the indirect method. So it starts with the changes in net assets, and then it adjusts for any non-cash activity going into the change in net assets. So for example, depreciation expense. So depreciation expense is a non-cash expense. And so you reverse that out of the change in net assets. And then you also take into account the changes in your operating assets and liabilities. So, and then that nets out to your change in cash from operating activities. Here is the cash flows from investing activities and the cash flows from the financing activities. And these are typically direct. So these are the exact cash amounts that were spent in these areas. So the investing activities includes investment in property and equipment, purchases or sales of investments. And then the financing activities will typically include, if you have a capital campaign going on, this example does have a capital campaign, but your collection of pledges for capital campaigns are typically going to be included in the financing activities. And then anytime you have debt, the proceeds from issuing that debt, receiving that debt is a financing activity, and then the payments made on your debt is a financing activity. And then this example, since it is the indirect method, it does at the bottom, you do have that supplemental disclosure that shows the cash paid for interest and the cash paid for income taxes. Okay. And then some other statement of cash flow considerations for nonprofits. There are some unusual things to consider. The first is for nonprofit organizations, and I already brought this up with the example, is that if they are collecting cash from a capital campaign, the cash inflows from the capital campaign are presented as a financing activity when they're received. And then pledges for long-term purposes are presented as an adjustment to operating cash flows. So they kind of have an impact to both sides there. The second item to consider is when an organization has restricted cash presented on the statement of financial position. So the restricted cash should be reconciled at the bottom of the statement of cash flows. So this is an example there where you have the total cash equivalents, and restricted cash at the end of the year after doing the cash flow statement. And then you'll take out any donor restricted cash as of the end of the year to where then that donor restricted cash line and the cash equivalents as of the end of the year, those should tie out to your statement of financial position. Okay, those are just a couple of things to consider for nonprofits. Footnotes. So like the statement of cash flows, nonprofits have the same basic requirements as for-profit entities when it comes to the financial statement footnotes. However, just due to some of the unique things in a nonprofit, there are some additional items that should be disclosed. So the nature of operations, there's a nature of operations section that is typically at the beginning of the footnote. And we like to recommend that nonprofits take advantage of this section to kind of disclose some of the core programs and activities that the nonprofit performs. Since management does share the financial statements with donors and others that are interested in the organization, this could include a lot of the key aspects of the organization's mission. And then just kind of some things as to what the organization is doing to help fulfill that mission and how they're using the resources obtained. So it's kind of a way to, just kind of a little section in the financial statements that you can use to kind of promote your organization, your mission, and how you're fulfilling that mission. Another unique disclosure in the footnotes is the liquidity and availability footnote. So this footnote was new with the new nonprofit reporting standard I mentioned, which came around 2014, 15, somewhere in there. But nonprofits are required to disclose the liquidity and availability of their financial assets. So this disclosure takes the financial assets per the statement of financial position, and then it shows how much of those financial assets are available for use within the next fiscal year. So nonprofits should also include verbiage for any additional resources available or any restrictions on use. So this is just an example of a way to present this. Some nonprofits include accounts payable and accrued liabilities and notes payable current. But a lot of them will just include the purpose restricted financial assets. There's some different ways to present it. We typically include AP just because you have that liability and you have to fulfill that liability. And so technically you have to use your financial assets to pay that to where that's really not available for future expenses within the next year. And then this one has an example of some additional verbiage for resources available. In this case, there's CDs available that mature at a later date, but if there's any immediate need, they could cash in that CD early if necessary, type of thing. Some other examples here are if you have a line of credit available that you haven't drawn on, you can include some disclosures here about having that as an item available for your organization. Okay, let's talk a little bit about promises to give. So promises to give are unique to nonprofits as well. And so this is a unique disclosure. So anytime an organization has promises to give that are due to be received in more than 1 year, not only will they be a long-term asset on the statement of financial position, but you do have to break those out in when they will be received. And so for the amounts due in less than 1 year, you have a line for that. Amounts due 1 to 5 years, you have a line for that. And then amounts due 5 to 10 years. And going forward, they have it in 5-year increments that you need to disclose when you're going to be receiving those promises to give. And then there should also be disclosure on a discount. So anytime you have long-term promises to give or pledges, you should be discounting those to present value. And so that discount on the present value should also be included in this disclosure. Okay, another unique item that's for financial statements, footnotes for nonprofits are if the nonprofit's in the capital campaign. And so if you are in a capital campaign, you can help users of the financial statements understand the capital campaign, where you're at in it. The table to the left just presents the activity and the pledges that relate specifically to the capital campaign. So you are required to disclose the total pledges and that, but if you want to include some additional information on the capital campaign, you can break them out here in an additional disclosure. This can also help connect the cash received in the capital campaign to the amount presented on the statement of cash flows. Because like I mentioned, that's going to be a financing activity down below. So this can kind of help tie those together. Okay. All right, investments. So nonprofits are required to disclose fair value information for investments, similar to for-profit entities. However, in the nonprofit financial statements, the investment income is typically reported as one line on the statement of activities. So an additional disclosure that is helpful in the investment section is you can break out the investment income. So in this example, this has the fair value disclosure in the top, but then in the bottom section there, it breaks out what the returns on investments are made up of. Whether that's interest, dividends, it could be net realized and unrealized gains. You can break out the realized gains from the unrealized gains or losses, and just show those to help readers kind of see where what the investment income is made up of. All right, and then we have net asset disclosures. So The net asset disclosures, they should include the with donor restrictions. They should be broken out in a footnote to provide additional information on the type of restriction. So earlier I did mention that you can break on the face of the financials in the statement of financial position, you can break out the you can break out the purpose restrictions from the time restrictions. If you don't do that on the face, you do need to do that in the footnote. So this is a footnote example. This top one shows this organization has 2.5 million in net assets with donor restrictions, and that's made up of capital campaign, purpose restrictions, and time restrictions. And then similarly, the board designations. So the without donor restrictions, if you have board designations, you should disclose what's board designated and what's undesignated. Like I mentioned, you can include that on the face of the statement of financial position or here in a footnote. And then finally, the footnote should disclose the release of net assets with donor restrictions, and that should be by type of restriction. So in this case, this bottom table just shows what those satisfaction of purpose restrictions were made up of. The total released was 5.5 million, and that was made up of capital campaign 4.9 million, and then other purpose restrictions and time restrictions. Okay. Other items, nonprofits must disclose any conditional contributions that have not been received but have been committed to the organization. So we'll get into revenue recognition, contribution, revenue recognition. But if a contribution is conditional upon an event or other circumstance, then that is not a contribution that should be recognized until those conditions are met. But if you do have those types of contributions, you should disclose that in the footnotes, and you should include the amount of that commitment. And then when a nonprofit has an endowment, there are also additional disclosure requirements. Those are a little bit more complex and aren't meant for this training, but will provide an additional training about endowments and those disclosures and just some additional information on those. Great. If anybody has any questions, we are happy to answer those questions. You can contact us on our website, www.larsco.com. And in the nonprofit section, we do have an area that you can submit a question or reach out or submit a request for us to reach out to you and help answer any questions you have. You can include your questions on that website. You can also reach out to me via email or phone. Our office number is 801-313-1900. And you can ask for me, Kyle Robbins, and I'm happy to answer any questions you have. So yeah, thanks for joining us. Find out more. There's our website. Like I mentioned, find out more about us at our website. And there's also the ability for you to submit any questions or just reach out to us and we can help you. Once again, I'm Kyle Robbins. I'm audit partner at Larson & Company and specialize in nonprofit accounting. Another individual, Richard Scoresby, you'll see on our website, specializes in the 990 prep, tax prep specifically for nonprofits. And his contact information is there as well, and you can reach out to him there. Once again, thanks for joining us. Hopefully you've learned something about nonprofit financial presentation, and hope to see you in other trainings. Thank you.